Have you ever wondered what it takes to orchestrate a $4 billion acquisition in the multifamily real estate sector? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. In a significant development in the Canadian multifamily real estate landscape, InterRent Real Estate Investment Trust has confirmed its agreement to be acquired by the CLV Group and Singapore's Sovereign Wealth Fund, GIC, in a transaction valued at approximately $4 billion. This move, reported by RENX.ca, positions the trust as one of the largest owners and operators in the multifamily housing sector across Canada. Mike MacKay, the President, Chief Executive Officer, and controlling shareholder of CLV Group, is also the Executive Chairman of the Board of InterRent. This acquisition is classified as a business combination under Canadian business and trading law, requiring approval from minority unit holders. InterRent's unit holders are poised to receive $13.55 per unit, a premium of 29% over its average value on the Toronto Stock Exchange during the previous 90 days. Furthermore, the price reflects a 35% premium over InterRent's closing price as of March 7th, the day before media speculation about the real estate investment trust's future began. The agreement includes a 40-day go-shop period, during which InterRent may actively seek and negotiate with third parties interested in acquiring the trust. This allows for potential superior proposals, offering a dynamic opportunity for InterRent's stakeholders. MacKay expressed enthusiasm about the transaction, stating, "We are delighted to partner together with GIC on this transformative transaction, combining our 50 years of operating experience and GIC's strong track record as a long-term investor in Canada and around the world. This collaboration aims to deliver exceptional value to residents through the combined operational excellence of CLV and InterRent teams." The InterRent board has unanimously supported the offer, which involves approximately $2 billion in equity and the assumption of the REIT's debt. While specific equity positions of CLV and GIC have not been disclosed, the transaction promises immediate and certain premium value to unit holders through this all-cash deal. Brad Cutsey, Chief Executive Officer and Trustee of InterRent, highlighted the strategic success in building a best-in-class operating platform and assembling a portfolio of well-located properties in Canada's strongest urban rental markets. This acquisition builds on InterRent's efforts to reposition these assets into high-quality communities, generating growth and value for all stakeholders involved. As of the end of 2024, Ottawa-based InterRent owned and operated a portfolio of 123 apartment properties, comprising over 13,000 apartments concentrated in major Canadian markets, including the Greater Toronto Area, Montreal, Vancouver, and Ottawa. The CLV Group, founded in 1969, manages a fully integrated real estate platform with $3 billion in assets under management and a development pipeline of over 5 million square feet. GIC, a global investment firm established in 1981 in Singapore, manages Singapore's foreign reserves and invests across various sectors, including real estate, in over 40 countries. This acquisition is a testament to GIC's commitment to long-term investments in Canada as it joins forces with CLV Group to enhance the multifamily sector. The Toronto Stock Exchange has approved the deferral of InterRent's annual general meeting, aligning it with a special meeting to discuss the transaction. InterRent plans to continue its regular monthly distributions per unit until the deal's closing. With a formal valuation range of $12.75 to $14 per unit, the acquisition is backed by fairness opinions from BMO Capital Markets and National Bank Financial. Legal and financial advisories are in place to ensure a smooth transaction, with Norton Rose Fulbright Canada LLP and Gowling WLG acting as legal counsel to InterRent and Scotiabank as the financial advisor to the purchaser. Termination fees are also set, with potential payments if the agreement is terminated during the go-shop period or under other circumstances, ensuring all parties are strategically aligned. In an exciting development for the Canadian multifamily real estate sector, GWL Realty Advisors has announced plans to sell the Diplomats, a purpose-built apartment complex in Burlington, Ontario. This move is part of GWLRA's strategy to dispose of non-core assets and reinvest capital into core holdings and newer generation, urban, income-producing properties. Senior Vice President of Multi-Residential Erica Penrose emphasized the firm's commitment to enhancing long-term performance by diversifying its assets under management with new development opportunities. The Diplomats, located along the shore of Lake Ontario, comprises two 10-story buildings with 203 residential units. Interestingly, 39% of these units have been renovated, and the complex maintains a strong occupancy rate of 97%. With existing zoning permitting further infill development, there is potential to develop additional density by adding more apartment or townhome units. This offering follows GWLRA's recent sales of properties in Edmonton, indicating a strategic shift in their asset management approach. But GWLRA is not just selling properties. The company is actively engaged in developing new multifamily projects. With several projects in planning, pre-development, or construction phases, GWLRA aims to deliver nearly 3,500 units by 2030. This ambitious plan focuses on high-quality urban properties, particularly those near transit and community amenities. Erica Penrose highlighted the importance of sustainability projects and upgrades that enhance resident experiences through improved amenities, technology, and living spaces. Among the developments in lease-up are 185 in Mississauga, the Livermore Westboro Village in Ottawa, and Le Livermore Ville-Marie the First in Montreal. 185 is a 35-story building with 365 units in close proximity to key destinations like Square One Shopping Center and Mississauga City Hall. The Livermore Westboro Village offers 336 units in Ottawa's trendy Westboro district, while the Livermore Ville-Marie Windroy in Montreal is a 46-story tower expected to be completed later this year. GWLRA has also submitted a rezoning application in Vancouver to transform a planned office development into two multifamily towers, demonstrating their adaptive strategies in response to market demands. The Canadian multifamily market, according to Penrose, is seeing a divergence where high-end properties face increased vacancies, while other segments are strained by limited supply. Monitoring factors like population growth and immigration policies is crucial, as Canada could face a shortage of over 1 million rental units by 2030. In a noteworthy collaboration, CentreCourt is set to join Dream Unlimited Corporation in a joint venture to co-develop a major two-tower multifamily project at 49 Ontario Street in Toronto. The announcement, made by Dream Unlimited, highlights the plan to introduce approximately 1,200 new apartments of various sizes to the market, with 22% designated as affordable housing. The development will feature two towers and a shared podium, offering around 800,000 square feet of housing space. Gavin Chung, managing partner and president of CentreCourt, expressed confidence in their expertise, stating, "We believe the skills and expertise that have made us leaders in condominium development will be just as valuable in purpose-built rental. 49 Ontario Street will deliver much-needed market rental and affordable housing to downtown Toronto, and we're excited to be partnering with Dream to make it happen." Dream Impact Trust, the current owner of the redevelopment property, has secured up to $647.6 million in government-affiliated financing, as well as waivers for development charges from the City of Toronto. The partners plan to initiate construction before the end of the year. In a subsequent release, Dream Unlimited revealed that CentreCourt has acquired a 10% stake in the project and will take on the role of construction manager. Jamie Cooper, president of Development and Income Properties at Dream, commented, "Dream has been at the forefront of delivering purpose-built rental through innovative public-private partnerships. Working with CentreCourt on 49 Ontario Street brings together complementary strengths to deliver a project that will serve the community for decades to come." This partnership marks a significant expansion of Dream and CentreCourt's collaboration into purpose-built rental properties. While both companies have a history of working together in condominium communities, this new venture represents a strategic shift in response to the current market conditions in the Greater Toronto Area, where the condominium market is experiencing high costs and low sales. CentreCourt's impressive track record includes financing, designing, and constructing 19 projects, totaling over 10,000 homes with a development value of $5.6 billion. Dream, on the other hand, has extensive experience in purpose-built rental projects and public-private partnerships, having developed or currently developing over 4,500 rental units worth more than $2 billion upon full build-out. Both companies are actively exploring additional purpose-built rental opportunities as governments at various levels are seeking ways to accelerate housing development and address affordability concerns. This includes federal initiatives like the MERB policy and the Build Canada Home Strategy, along with reductions in development charges. Dream Unlimited is a Toronto-based developer with a robust portfolio in office and residential assets across Canada and the United States, managing $28 billion in assets. CentreCourt specializes in high-rise condominium and purpose-built rental communities strategically located near major transit amenities and employment hubs in the Greater Toronto Area. Thank you for listening to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. See you on the next one.